So what we're looking at here is, of course, just the standard 14-day free trial to PowerOptions. You see here that we have the 4 steps available to help you get more familiar with the tools and the option strategies in general. So if you're just starting out, I encourage you to take advantage of those 4 steps. You can get the quick start guide, free flash tutorials, access free webinars, the archived webinars, and more. And of course also the free coaching sessions. Trial members and subscribers can schedule free coaching sessions at any time. All right, so I do have a couple of questions that have already come in. But let's just do this real quick. That is very strange. Give me one moment. I do apologize for that. What happened was it just seemed that something had been missing. There we go. That's much better. I apologize. Let's get back. There we go. Okay, so now here we are, and I had mentioned that you can click on the free webinars tab to access the webinars, and the free coaching tab here as well to schedule a session at any time. Okay, right down to it. First question comes from Mark. Mark says, I'm going to say I don't know what to do with this market. You have a number of VXX credit spreads on the volatility ETF, and a few debit diagonal SPY positions, swings up and down. Otherwise, mostly flat. Approaches to the current market are welcome. Okay, well, let's see. I've closed out most of these positions, some of these positions here. Let me get rid of them. IBKR, PHM, SNE. Now, there we go. Okay, so right now I am in Goose, which is doing well. It's in a married put position without a sold call. It's currently at a profit, and it jumped up today. Earnings are coming out in 8 days. Ollie, of course, I have as a collar, a put out to January at 85, 95 near-term call sold against it for November. Penn is an interesting one. I bought the stock at 33. It is now down to $23. But I bought the stock at 23, bought a 35 put. Sorry, folks. Bought a 35 put, so the maximum risk is at 5.9%. This was opened on October 2nd. On October 5th, when I saw MACD crossover to the negative, I bought a 30 strike put for 145 to sort of create a synthetic straddle, really a strangle in this case. And this is my profit and loss at near-term expiration, so I'm making about 9%, even though the stock is down about 30% from where I got into the position. I had 2 bull put credit spreads expire worthless today. One of them was really risky. I'm going to be honest with you, Mark. I don't know if I'm going to open any bull put credit spreads on Monday. I'll tell you the truth. Even though they come up in the search and what I look for, I do have 2 diagonal spreads open right now. Both are treading water like yours. What would I be doing going into Monday if I felt the pressure to open new trades in my portfolio? Which I don't. I've got a couple diagonals open. I've closed most of my VIX calls, by the way. I think I have 2 contracts open of a 16 strike for November expiration. I think it's the 18. I think it's the 18. My apologies. If I'm going to open something next week, I'm going to be very cautious. And I'm going to look for something very single-digit risk. And there's a lot of stocks that did move up today, as you saw. 2 of mine were up. Well, this one went up as much as $2 today before it pulled back. It was almost at 95. Ollie, I saw at 94.90 today. Goose, of course, went up about 5% today. And Penn dropped, but I wanted to do that. And the market did start up, but it ended down. Okay, so am I saying we're in a consistent downtrend right now? I'm not really sure. I don't know if you are either. So if I was going to open positions with the idea that I don't know what the market conditions are going forward right now, to be honest with you, I might open 1 or 2 long straddles that maybe have 3 weeks to 4 weeks to expiration. So it would carry me through the midterms. I'd only open a straddle where the cost of the put and the call and the number of contracts only represented maybe 4 or 5% of my total portfolio value. So if the stocks don't move for the next 3 weeks at all, the most I can lose is 4% of my portfolio. The other thing I would probably do right now if I was going to open anything, I might open some long straddles with or without stocks that have earnings coming up. I might just open some straddles on SPY. If, again, I can afford to pay the price where it's only 4% of my total portfolio value. I want to control things to single digits right now. I don't want to take a chance on any out-of-the-money bull put credit spreads or bear call credit spreads, even with an 85% probability or higher that I'm looking for. Where if I take a loss, then that might represent, I'm sorry, let's just go to bull puts here. Oh, I took it off. Let's add it back in. So I'm going to go to other strategies here. For the time being, I'm definitely going to take out Iron Condor. Let me add bull put credit. Okay. So if I was opening bull put credits today, I'd still keep with my 2-week out cycle, the weekly bull put search that's the default on PowerOptions, looking for probabilities of 85% or higher, and there's a lot of candidates here. But you see, most of these are looking for net credits of 27 cents on a 2-point spread. This is about an 8-to-1 risk-reward ratio. 5-point spread was 65 cents, about a 9-to-1 risk-reward ratio. Okay, 39 cents on a 3-point spread, again, right around 9-to-1. Okay, so I don't know if I want to take that the way the market has been. If I'm concerned that the market might go either direction and I don't know, the standard bull put credit spread with the high probability might not solve that problem for me. Where I'd enter a bull put spread where the stock's up here, I've got an 85% probability that it'll stay above this, but the way the market's been swinging back and forth might not be a good trade, because to get that 80% probability, I know I'm taking a 9-to-1 or 10-to-1 risk-reward ratio, 8-to-1, 9-to-1. Okay, so again, the bull put, even maybe the bull call debit, even an out-of-the-money bull call debit, where if the stock was, let's say, right at, well, let's just take Goose. If the stock was at 58, where it is, I don't know if I'd sell a 60 call right now and buy, let's say, a 55. So this might cost me a small debit of $250 to get into, with a potential to get 5 points back if the stock is above 60. You don't do that with a bull put, because that would be an in-the-money put where you might get assigned early. You would do this with a bull call because you'd be selling a just out-of-the-money call and buying a just in-the-money call, and you get closer to a 1-to-1 ratio. Maybe go a few weeks out in time speculating that the market is going to recover. However, remember, even though you only invested $250 into that net debit, you could lose 100% of this if the market goes the other way. And I wouldn't do it on Goose anyway because they have earnings coming up. I might do the straddle in that case a few weeks out. Sorry. So a straddle, you don't know which direction the market's going. You don't know if it's going up or down. If you can get a good price without paying into too much volatility, a straddle or a strangle, where you buy a call and a put at different strike prices, so you get more of a U-shaped profit and loss chart instead of the V, wider upper and lower break even, of course, because your call and put are out of the money. But a straddle or a strangle, if you don't know which direction the market goes, maybe you go 3 to 4 weeks out. And if the first week or two you get a profit, 20, 30, or 40%, maybe you take that off the table. Okay, maybe you close that out. And again, on the other side, if it moves up, then maybe you take that off the table or hold on to it. Now, I mentioned I wouldn't do this with Goose. Why? Because I know they have earnings coming out on 11/8, so the implied volatilities are drastically increased. Okay, so it's really, really expensive. But if I bought just one contract of the call, one contract of the put, I'd still want to make sure that the total cost doesn't represent more than 4% or so of the total portfolio, because if the stock doesn't move at earnings or just moves up 1% or down 1%, I could lose 90, 95% of what I invested in that trade. So it shouldn't be more than that 4%, 3%, 5% of my total portfolio. One thing I might consider doing now, Mark, and I think you've done these before a little bit, but I might open a collar. Look for a stock that I feel has been strong while the rest of the market is down, something that's still above its 20-day or 50-day moving average, maybe still has a positive MACD. But rather than going maybe just 1 week out, 2 weeks out, I might go 3 weeks out in time with the call and the put, keep them in the same expiration date, 28 days out. Maybe a little bit less than that. These are pretty far out, so I was at 5 to 55. I'm just going to go 28 days out. Well, let's go 29. Okay. That way we'll get the 28 still in there. Okay, I want the call expiration to be equal to the put expiration. Yeah, I don't want the... Oh, this is a conversion. I'm sorry. Let me transfer back over to the standard one, Mark. There we go. Same thing, though. I want a fire and forget trade that's not going to risk more than 4% of my investment with the potential to make 2 or 3% if I get assigned. All right, so 10 to 55. I mentioned we're going to take that down to 29. I might even go weekly, but I'm going to leave it here. I want the put to be equal to the call. Standard collar. Max risk, no, we're going to put that less than 5%. Monetary max risk is fine. The percentage is more important. Max return, I'm going to lower this a little bit. Well, maybe just take it to 2.5. Yeah, call out of the money 0, put out of the money 0, that's good. Call bid, maybe just greater than 85 cents instead of $1, but the dollar's fine. And the net premium, difference between the call and the put. I'm buying a stock, selling a call, and buying a put. I'm going to keep my net premium at probably 45 cents, 50 cents. All right, now, I'd mentioned some technicals. I'm probably going to want a stock that's trading above its 20-day moving average. Not going to worry about volatility. Average stock volume, yeah, I want something that has good volume. So I'm going to put in 750. This is measured in thousands, so I'm looking for stocks that have at least 750,000 shares per day. And I'm going to look for a positive MACD cross, where the MACD has crossed the signal line. I'll share that in just a moment. I'm going to look for something that's maybe crossed over at least 2 days. Okay, where the MACD has gone above the signal line the last 2 days. Stock with a good earnings per share, good PE ratio, matches my purchase price. I may avoid earnings between now and expiration as well for this strategy. Okay, is there anything there? Now there should be, but I might have to remove several things. Oh, actually, I'm not doing too bad here. There's only 12 results. Kohl's looks good. Twitter, I don't know if I'd do that, but Procter & Gamble is there. Nike is in there. That's a pretty decent one. Let's see here. This isn't bad. It's a 14-day trade. Buy stock at 76.47. Sell the 78 call for 102. Buy the 72.5 put for 50 cents. Max risk of 4.5%. Max profit of 2.7% if it's above 78 on standard November expiration. Now, I do other research and look at the chart. I'm going to look at the chart right now, as a matter of fact. I do apologize. So one of the signals that I use, of course, when looking at big charts here is the MACD that I mentioned. So I want stocks where the blue line, the MACD line, is above the EMA 9. Okay, so I'm looking for stocks that are just had a recent crossover here. Look at this. It's just crossed the 20-day moving average, bounced off the bottom, just had a positive MACD, and the RSI is increasing. So I wouldn't suggest doing a bull put credit spread on this, even though it has the 3 criteria technicals I might look for in this scenario, because I don't know where the market's going. I'm not confident. Oh, I'm sorry. I'm not confident. So what I might do instead is do a standard collar. And you might say, now wait a minute, Mike, this looks exactly the same as the bull put spread. But remember, if I did a bull put spread, I'd probably be selling a 72.5 put and let's say buying a 70. Right? So we'd have a little profit and loss chart here. But if the stock falls below 67, I could lose 100% of what I have invested into that spread. Here with an investment of $7,500, almost $7,600, the most I can lose is $342 or 4.5%. And if Nike continues and goes above 78, I can make 2.7. But even if I'm wrong, I can only lose $342 or 4.5% of what I invested in this position. Okay? Could you do similar parity trade, a bull call debit, where you just sold the 78 call and bought the 72.5 call? It will give a similar risk-reward profile, but whatever the monetary risk is, and it might be close to 342, it might be a little bit lower than that, but remember you're risking 100% of that. So one contract would be 342. 10 contracts would be 3,420, and you could still lose that as well. Okay, so let me just take a look here. There we go. Okay, let's see here. There you go. Okay, let's see here. Just looking at some follow-up comments. There we go. I'm sorry, hold on. There we go. I'm sorry, folks. Okay, good. So I wanted to see if there's any follow-up questions, and I have one that's kind of related to this, but not in this situation. So again, my thoughts are, if I'm opening anything on Monday, and usually I won't, I'll wait until Tuesday just to see if the market continues, I'm going to look for a long collar that's maybe at most a 2-to-1 risk-reward ratio or less, okay? I make a little bit if I'm right and not lose too much if I'm wrong. If the stock stays right between the two, let's say it goes right to 77 mark for the next 14 days, well, I'll still have somewhat of a profit, but if I'm more comfortable with the market at that time and my collar expires, maybe now I convert that to a radioactive trade. Maybe I just keep trading it as a collar for another 14 days at a time, rebracket it in a sense. And if it goes up and I get assigned, I'll just let it get assigned. But if I like Nike, now that I've seen it perform, maybe now I convert it to a different position now that I'm a little bit more comfortable. But controlling the risk, and if you're not sure of the market direction, straddle or strangle, where the total cost only represents maybe 5% or less of the total portfolio. So even if you're wrong and you don't get the movement you're expecting, you're only losing 5%. I'm not comfortable with credit spreads right now. As I mentioned, I had my 2 expire, but one I was really watching carefully as we got closer to the end of the day because it was really close. Thankfully, it expired worthless. The other one was fine. However, I don't think I'm opening new credit spreads on Monday. I don't think I'm going to be looking at a debit spread or opening a new diagonal calendar or even a calendar put at this point because I'm not comfortable that the direction is solid. So I'm not going to open a long call or a long put because I'm not sure the direction. Looking at a straddle, strangle, a long collar position where I'm still neutral to bullish, looking for neutral to bullish stocks, still looking for a reasonable return with controlling risk. I'm going to jump ahead now. I've got several questions from Rhajiv that came in. I've got a question from Paul, but I want to take this question here first. Let's see here. All right. And I don't know the name. The name is the email. Okay, so it's ALH. All right, so ALH says, good afternoon. Aware of the role of volatility, but wondering what's the best way to determine if there's a high or low volatility when placing a trade. Also, due to the size of my investment budget, mostly practicing with credit and debit spreads, however, notice gains are very small. Yeah, any way to improve that while keeping my risk small. Okay, so back to what we were talking about in a bull put credit. I'm just going to go back to the bull put credit set first. Okay, we're going to take a look at a bull put. We're going to take a look at the bull put I have in my default settings, again with the 85% probability. And we're going to take Lamb Research. Stocks at 151.87, 2 week out, selling the 140 put, buying the 138 for net credit of 27 cents on a 2-point spread or a 15.3% return. It's about a 6-to-1 risk-reward ratio. Let's go to the profit and loss chart. Now, this is out of the money by 11 points, about 10%. Oh, a little bit under that, about 7.5%. Does have an 85% probability. Net credit around 27 cents. Maximum risk is 174 for one contract. So we can say, again, that this 174 is a low risk, $174 for one contract. If you do 10 contracts at this position, it's 1,740. Now, you have a known risk. I wouldn't call it a low risk. Okay, even at 1, that's a very low risk. Okay, but you're risking 100%. You could lose that full amount. So again, the number of contracts to me in this spread would be dictated by keeping this monetary amount. If I did 5 contracts, let's say it goes up near $1,000, that should be less than 4% or so of my total portfolio value. So even if I do lose 100% on this because of a market correction, Lamb goes below 138, I haven't lost more than 4% of my total portfolio. But ALH, this is the trade. I'm just going to say Al. Okay, Al, this is the trade-off. Okay, and the reason why is that in order to get that high probability, you're taking a 6-to-1 risk-reward ratio. You only hear it's about a 7-to-1, isn't it? It's about a 7-to-1 risk-reward ratio. That's the nature of the game. Can I get into a bull put credit spread that has closer to a 1-to-1 risk or has a higher return? Yes, but I have less safety and lower probability. All right, so we're going to remember this, 140, 138. LRCX. I'm just going to go into the custom spread tool again on a new window for LRCX. November 16th. And I'm going to sell the 148 and buy the 146, maybe the 145. I'm going to keep a 2-point spread. Okay, but I'm going closer to at the money. Now this is a 60-cent net credit for 140. So you see now we're basically at a 2-to-1 risk-reward ratio with a 43% return. What's the probability that the stock will be above 148 at expiration? I'm going to say 61%, 58%, probably 58%. Let's check. Okay, so when you're on Power Options now, Al, what you can always do is use the More Information button, whether you're on the search, whether you're analyzing the position on the custom spread tool, go to Research and go to Option Research. All right, this shows you all of the data that we have for the option. And over here on the right, I can see that the current implied volatility is 0.3965. The total volatility range is 3079 to 0.5041, or what you might say 30.8 to 50.4. We're currently at 39. We're almost right at the middle. We have a percent IV range of 45%. This is over the life of the option, since the option was released on the market. So it's showing you right now, is the option implied volatility extremely high? Is it extremely low? Or is it right sort of in the middle? And is the range big? This isn't that big of a range, to be honest with you. 30.8 to 50.4. It's reasonable. It's sizable, but it's not huge. A huge range would be 0.20 to 0.85. Okay, something that's been really snapping back and forth, and some stocks do have that. And this is where you can see it for the specific option. Also on this page, the option research page, which you can access from the option chain, the search, or if you're looking at a specific option on the custom spread tool, down below we have a graph here which shows you the price change versus the implied volatility, but I can check and look at that versus, I apologize, percent of a sign, that's not what I was looking for. I thought probability was in here. But option, last price, Black-Scholes, stock price, volume, open interest, and more. Okay. Now, another thing that you can see here on this page, I prefer to look at the percent IV range to see where my implied volatility is. This one's pretty low. Okay, this one's not really that high. But it does show me that right now the IV over HV, the implied volatility of this option divided by the stock volatility is 1.1. That means the implied volatility is 10% higher than the historical volatility, meaning it's considered roughly 10% overvalued by comparing the stock volatility to the option volatility. Okay? But again, there's that probability, 63.8%. The spread we just showed you, spread we just showed you gives you a high return. It's a 2-to-1 risk-reward ratio, 43% return with a 63% probability of expiring worthless. The spread we found is only a 15% return, making $27 against 174. Again, about a 8-to-1 risk-reward ratio, but we have an 85% theoretical probability. So even though you're not getting the return that you want, what falls into your trading plan? In other words, is it better to open positions that only have a 64-65% probability but offer a 35 to 45% return? So when you're right, 65% of the time, let's say you make 40%, but when you're wrong 35%, you lose close to 70 to 80% because it's a much smaller move to hit the maximum loss. Our bought put was only at 146, remember, let's go back, was only at 146. If there's a 5-point decline, I'm losing close to that full 100%. Okay, so this is the trade-off with credit spreads. Now, is there any way to get a higher return with keeping your risk small? And we showed you on the credit spread, this credit spread does have a smaller risk because you got a higher net credit. But I don't think that's what you want. Is there something that gives you a better probability with a higher return? Well, someone in line here mentioned iron condors, okay, saying that you could double the credit you're talking about here for these credit spread, this bull put credit spread with an iron condor. This has not been the time to be doing iron condors. You're losing on the call side, then you're losing on the put side. Market swinging, you're hitting a stop on the call side, hitting a stop on the put side. It hasn't been the time to do it. You double the net credit, you can still set it up to have an 85% probability between the two strike prices. So what is this here? 140. It's 11 points down. What would I do with a condor, Al? Well, I've already got 27 cents here. Remember, we're about 11 points. I'm going to call it 12. All right? So we're 11 points out of the money with the 140 put. So I might add a bear call. Okay, it doesn't give me the single, so let's do a 162.50 to 165, right? About 11 points up from where the stock is now. And I'll just do a bear call spread, sell and buy on the same stock. Now here's a nice wide iron condor, break even up at 163, 12 points away, 12 points away. This is not a recommendation or suggestion, this is just looking at a structure. You increase your return $58 versus 192. Hey, we're under a 4-to-1 risk-reward ratio now, 30.3% return as long as the stock stays between the two strike prices. You still make a profit if it stays between the upper and lower break-even as well. But what has this market been doing? It's been Dow up 600 points, then down 400. I'm sorry, down 600, then up 300. Then down 200, then down 100, then up 200, then down 400. This is not the strategy for that kind of market, okay? Although it doesn't have a high probability, you can't really track the probability of success on buying a call, buying a put. You can track your own rate of success, but you can't say the probability of a stock going above to reach a 20-30% profit. I can buy a call now and have an 85% probability. No, no, no. If I buy a call now to get above my break even and to get to a 10% profit, statistically, the numbers might only be a 20% to 10% probability. That doesn't sound that great, but you're bullish on the stock and looking for a leveraged return. If you feel you have a good grasp of the market direction, Al, you might be able to buy a call and buy a put, and you still have a known risk, but you're looking for infinite gain one direction or the other. And if you're wrong, you have about the same monetary risk of doing a credit spread, don't you? Now, here's a risk of 192. Well, I could buy probably the 150, 160 put for maybe $2 and have about the same risk. Okay? Buy a cheaper out of the money one, have a lower risk but lower probability of success because you need the stock to move in that direction rather than stay the same. So it's a fair trade-off, and it's a great question, but those are some of the ideas. And again, just what we talked about before, a straddle or strangle if you're expecting movement to continue. Not stagnation, but maybe even after the midterms here coming up in a few days, you expect the market to recover, to calmness. The volatility is gone now of what's going to happen, and hey, it has happened now, and you expect it to push up. Or if you're wrong and it pushes down, 3-week out, 2-week out, straddle or strangle, maybe an out-of-the-money strangle on SPY, you still know the monetary loss you can take. Right? So instead of the credit spreads you're used to, let's go back. Let's go to the custom spread tool. And let me clear out this. Let's just go to SPY. So I don't know what the market's going to do, but 3 weeks from now, maybe even further out in time, I'm going to go 28 days. I'm going to go to that monthly November. Okay, we know there's a lot of volatility right now, which is going to increase our options about at 272 price SPY. So maybe I go a little bit out of the, let's just go 275. 3 points down, and let's go to, whew, that's expensive. Wow, both are very expensive. My apologies there. I knew they'd be expensive, but I didn't figure that much. All right, so buying a 268 put and a 275 call on SPY, looks like we're going to have an investment around $720, $735. Upper break even would be 282. A lower break even would be yeah, I don't know if I would do it. That's too expensive. I'm going to be honest with you, it's too expensive. I think the implied volatilities are too high. But let's take a look. How do I do it again? Do the research, options research, over on the right. Oh wow, this actually corrected myself. This is actually at the lower range, but the range is so small. It's 0.16 to 0.21. But they're still pretty expensive there, so I don't know if that is a good play. But look at the I'm sorry, folks. Look at the chart. What happens here? I'm sorry. As you extend out, is that U-shaped profit and loss chart we talked about. So we're not sure which direction the market's going to go. If we think it's going to swing one direction or the other, you have a known risk on the table. You can't lose more than that, and that happens if the stock stays between and you don't do anything to manage the position. It could have outsized gains if it really takes off, but right now the prices look a little bit rough. And see, this is the trade-off. We saw that nice-looking iron condor on LCRX, right? On LCRX, that had that 30.3% return because of implied volatility. The implied volatility is there because the market's swinging quickly. That's not the strategy we want. When the market's swinging, I want something more along the lines of a straddle or a strangle view to try to take advantage of those swings. But it's going to be expensive. Okay, and that's sort of the problem. Okay, so higher profit, well, might be straddles, might be strangles, might be long calls. Again, I'm in the mood to control risk right now if I'm staying in the game and not staying on the sidelines. I'm going to address the sidelines in just a moment. So if I'm going into something, again, just to reiterate, on Monday or Tuesday, I'm probably looking at the straddles, but I'm going to look for inexpensive ones where the debit to buy the call and the put is not maybe higher than 5-6% of my total portfolio, but also is probably not 5 or 6% more than the underlying stock price. In other words, the total debit I pay is not more than 5 or 6% of the underlying stock. Because if I buy a straddle or strangle where that cost of $8 to get into one contract represents 12% of the stock price, that means I need a 12% movement either direction to break even. That's a lot to ask in a 3-week period. Of course, saying that, I've watched one of my trades, the Marion put trade I mentioned in Penn, from basically October 3rd to October 30th, 27 days, watch it drop 30%. So anything is possible, but you want to put yourself in the structure that matches the market, and any trade you open, whether it's a credit spread, whether it's a long collar that's capital intensive, but you know the risk up front. But that monetary risk for the collar, the monetary risk of the bull put credit spread times your number of contracts, the monetary risk for a long call or long put times the number of contracts should not represent more than 5% of your total portfolio. So if you do lose 100% on the long call, the bull put, you're only losing 4 or 5% of your total portfolio. Paul. Rhajiv, I see your questions, but your questions are sort of one after the other, so I'm clearing up these ones first, then I'll get to yours. Well, Paul asks, I've been on the sidelines for a while. I'm still a member. You did buy the blueprint from Radioactive Trading. Is there a way that I can find out? Well, yeah, I mean, you did buy the blueprint. Okay, so you think I'm pretty sure you did. Let me just check here real quick. I do apologize. Oh, I'm sorry. Give me a second. I know everyone's paused right now. I do apologize for that. I'm just looking something up here as we go. And I can always email you after the webinar, Paul, but let me just take a look here while I can. Let me just make sure I'm still paused and everyone's still looking here. Okay. My records show, and you're not going to see the records, you're just going to see PowerOptions, but my records show you did purchase the full home study course, the home study kit, Paul, back in 2014. Okay, so you do have the blueprint. Of course, what that means is that you can log on to Radioactive Trading at any time. Hold on, folks, I know you're not seeing this. There we go. All right, so you can log on. There we go. Okay, to Radioactive Trading at any time. using your credentials, your email address and your password. And as a Blueprint owner, you can look at the Blueprint owner only webinars, or you can look at the latest revisions from your edition in 2014. And this has the PDFs of all the recent updates we've made, and we're up to edition 15 now. So you can walk through that, and you can download those extra ones as well. So Paul, I do show that you owe the full home study kit, and that you purchased that back in 2014. You can get access to things such as the Blueprints revisions, Blueprint owner only webinars, and more. Just go to radioactivetrading.com, log in with your email and the password, same one you're using for PowerOptions, and you can check that out. So that, I think, answers your question. But Paul, if you had a follow-up question about, I'm not sure if you're waiting for a follow-up question to ask, should you be trading married puts now, or could you be trading married puts now? The answer is yes. Ernie opened a position a couple days ago. I was just looking at new married puts today, but I was just going to wait until I closed the pen position, but probably not. Cadence, Tractor Supply, these are all ones that are still above their 50-day moving average and still have a very nice controlled risk. I've been looking at mainly these two, CDNS, TSCO. CDW came up the other day, but I haven't had time to really research it as well. Okay, so those are positions I might be getting into and might be looking at as well along those lines. If I open a married put, if I do open a stock position, it's going to be a married put or a collar naturally next week. If I open a married put, it's probably going to be one of these three, CDNS, TSCO, I haven't looked at CardioNet yet, or Kirkland Lake Gold. But these still match the criteria we would look for to open a position. Still trading above their 50-day moving average, and we saw that there was not a lot there as well. So we'll go ahead and take a look at that. Okay, so let me start with Rhajiv. 1, 2, 3, 4, 5 questions in a row. All right, Rhajiv's first question is, before Facebook earnings, I created a caller, 141 put and 146 call. Stock's at 150.35 right now. Okay, with stock around 143, now out with a profit. Does it make sense to stay longer or not? No. Again, I talked about it a little bit earlier, Rhajiv. It wasn't related to your question, but as I was talking about Mark's discussion with using the standard collar position, so let's fake a trade, and I don't remember when Facebook's earnings were. Oh, I'm sorry, I think I just deleted it. It's not important. I'll just say that, let's say we bought 100 shares of Facebook at 141. I know that yours were different numbers. I just forgot them, but I kind of know the range. And let's say that at the time, even though the stock's where it is right now, let's say that I had bought the 140 put and sold the 143. And at the time, this was probably worth 120. And this might have cost me, let's say, 70. Or it's probably a little bit different, but oh well, let's look at a collar here. I did that wrong. There we go. All right. So when I'm looking at a standard collar, yes, this one was a sign, not a great return, but that's okay. You would have entered it, would have matched your goals. So if the stock moves up and I am looking at assignment, whenever I open a collar, it's because I'm very comfortable in the best case scenario. Meaning that if the stock is above that and I get assigned, I am going to take the return and move on. Okay? If I still like Facebook, I might just buy it new. Buy it now at 150. Sell the 152.5 call, maybe buy a 148 put if that matches my goals, rather than worrying about rolling this and staying in it. You could do that, but remember my rule of thumb. All right? When you opened a collar, I don't know if we've discussed this recently, but when you open any position, a collar, bull put, credit spread, or so forth, let's say my goal, this was a 7-day trade or 14-day trade, I'm looking to make 1.8% on the position. Okay, that's my goal. This offers a lower risk here, but let's say this is my goal. If I move this up and keep the same expiration date, because it's still 14 days away, now that it's gone against me, if I do sell that 152 call and buy the 147, right, I'm going to get a new collar structure. If this new structure doesn't have a max return of 3.6%, it's not really worth it for me, is it? My goal was to make 1.8% every 2 weeks. If I roll up the collar that existed, and sure, it gives me 2.2% return, let's say. Well, I'm still getting 2.2% in 14 days. Why not just take the max now and move on? And I know it's not the max now, but if I rolled this, let's say it was this expiration, November 2nd, and I'm getting 1.8, and I roll it out to the 16th, I increase it by another 14 days, but the return only moves me to 1.9, 1.8%, that's not really worth it to me, is it? I'm not keeping in my spreads. Let's look at a real example. Okay, maybe I'm going to take Facebook. We'll stay with Facebook. I'm going to go to the options chain. I'm going to go back to Monday. I know the market's been crazy, but we're going to go back to Monday historically. Wow. October 29th. All right. And so a 1 week collar with the stock at 142. It's right about the same price as you had mentioned. So on Monday, October 29th, I'd buy shares at 142.10. And for this week's expiration, I'm going to sell the 143 and buy the 140. That's going to be 620, maybe a little less, maybe 615. For the 143, 560 for the 140, okay? So it's almost $1. Not quite, but almost $1 premium. That's good. Now let's put that into the custom spread tool. Sorry, folks. Yeah, there we go. So we're going to change my prices. This is what could have been on Monday. Buy in at 142.10. Sell the 143 call, but because earnings were coming up, it was actually at a high price of, I said, 615 and then 565. And this is for November. Oh, sorry, this is for November 2nd expiration. I do have to change that. 143 call, 140 put. All right, 615. Good premium. But if the call is high, hey, so is the put. 560. All right. Not bad. 1-to-1 risk-reward ratio. That's great. The stock moves up to 150 because of the earnings. And then I have the choice to get assigned for 1% profit for a 5-day collar that only had a 1% risk. Pretty good return for a 5-day trade. But now I say, you know what? I want to go up to the 152, 148 for the 16th. I'm going to go 14 days out. Let's just go 1 week out. Let's go to next week's expiration. So before the market closed, I'm going to buy to close my current position. I'm going to sell to close the put, buy to close the call. The reverse action. So we sell to close the put for probably nothing. We buy to close the call for about $7. $7.25 roughly. Okay, so where do I stand now? I now, after closing everything out, I have a cost basis of $14,879. Okay, because it cost me the $7 to buy the call. That goes back into the cost basis. But I'm at a profit because stock's at 150. So now, one thing I can do real quick, we're just going to call this 148.79. That's the stock price, right? That's the cost basis, 148.79. So this increased 148.79. Nope. These are all closed out. Bought back that call for $7.25. Took in some premium at the beginning, but now I'm going to go out one more month, or one more week. I got to do the 152.50, and I said 148 and 147. Let's go with the 47. This is terrible. That's not going to be a good premium at all. So I'm going to take in another $1.82, spend another $1.58. All right, so my return is 2.7% now. This one's viable. Okay, this one I might do because it took my 1.1% up to 2.7. But if it gets too far away from you and you roll the collar, you might only increase it by 0.5%, and that might not be meeting your goals. Okay, so there's nothing wrong with what you did. If you do decide to roll a collar, Rhajiv, you've got to make sure it's going in that direction. Okay, you got to make sure that it still matches your trading plan. Okay, so you also mentioned you're in diagonal spreads on Under Armour and Lowe's. Okay, yep, doing it a diagonal there, so we'll have to see how that turns out with the market. Last couple days probably looked pretty good, but today was a little weak if you're doing a diagonal call spread. Okay, and then for MU, you'd mentioned now one more update on MU. You have not done the 38.40 bull put spread for November standard. Should you keep it as is or make any adjustment? Well, naturally, we got to do anything now. I'd wait to see what the market does on Monday and Tuesday before deciding what to do on that protected position. We talked about it last week. I don't remember the specifics. I don't need to know the specifics. What I want to just want to take a look at here. Sorry, folks. I want to look at MU real quick, just as the quotes. Because I haven't been following MU at all since we talked last Friday. So yeah, I mean, it's going pretty good. Just like we saw earlier with Nike, just had that MACD crossover with a push today, and some of the market has just gone above its 20-day moving average again, off the bottom Bollinger Band, and the RSI flattened after it's climbing. So it'd be interesting to see what happens on Monday. Naturally, we've got to wait to Monday to anyway, but if that continues, it might look for a good trend. It might be a good trend to look for potentially bullish spread. Rhajiv, I don't even want to, I'm going to answer this question or follow it, but I think you're going too far down the rabbit hole here, okay? So Rajiv's last question says, ratio spread with help, example, find the ATM. Sell one put and buy two put with strike equal to ATM. I don't understand what that means. They have to be different to do a ratio spread. So you can do a back spread, you can do a full ratio spread. You're saying at the money, you can't buy one and sell two at the same price. Naturally, that doesn't work. They just cancel each other out, or one-to-one cancels each other out. So I'm really confused what you're asking. You say ratio spread, find the ATM, sell one put and buy two put with a strike equal to ATM. If ATM SPY is 10, go in the money of put with, say, 282 strike SPY and sell a bear call spread to cover half the... Wow, that is just too much. I'm sorry, that is going way too much and way too deep into a confusing position that I don't think is beneficial in any direction. Let me just take standard. You said 282. Well, that's not at the money. The ratio spread at the money. All right, so maybe I do something like this. I buy a 270 and sell two 271s. 50s at the higher price, and then buy a 282. Okay, I don't even know if you mean the same expiration now. Yeah, I'm lost, but I think you're overcomplicating things. I think if you want to do a ratio spread, do a ratio spread. I think if you want to do a bear call, do a bear call. I think combining these things too much, okay, this gives you sort of a weird thing here, and then you want to pay for half of it by doing a bear call spread on top of this, and I have to do an out-of-the-money bear call spread. Let me go to 275 to 277.50, a 2.5 point bear call, which will increase the margin requirement. Remember, you pay for half the cost, but now you're increasing the margin requirement because you got to cover the 250. Didn't really change the graph too much, did it? Still a risk of 760 to 540. I know this isn't the spread you're looking at, but this is, you've overly complicated a bear call credit spread if this is what your structure was. This is similar to a bear call credit spread, except for you've got this little bump here instead of the profit just going this direction. It's already out of the money. I'd say if you want to do a bear spread, do a bear spread. Don't overcomplicate it with this idea. This to me just looks like a bear call spread with a little bump in it. And you're not getting much extra protection out of it. It's a risk of 760. Okay, it's a risk of 760 to make 540. Okay, I get it now. You're trying to look for that high return. But if your goal was that you think it's going to stay below 272, I mean, I might just stick with this. I've got a risk of 144 for 106 at 73. 73%. The risk of only 144. I must have built that wrong, because to me, what you described there does not look like, I would just stick with this bear call. It's the same risk reward profile. Doesn't have the probability I want, but I don't expect to make a 60% return with a bear call credit spread. But what I just built looked like an overly complicated position that just looked like a bear call credit spread profit and loss chart where the risk was 700 and the max profit was 540 at 60%. If this is really your expectation that's going to be below 275, just do the bear call. Don't overcomplicate it. Don't jump into that extra margin requirement for the ratio spread or the cost of the extra long put. Okay? All right. Okay. Sorry, forgot the name. Different James. James D. We had Mark earlier. Oh, we didn't have a James yet. I'm sorry. We had a Mark earlier. This is James. James says, I have been on these calls in and out over the past 6 months. All right. And he says, my question is, you used to guarantee that we would make at least the cost of our subscription. Is that still in effect? Yes. Okay. This is called the performance guarantee. It's right there on the top of the subscription page. It says that, well, we can't promise everyone will make a profit on their options trades. Your subscription to PowerOptions includes the following guarantee. If during any month you don't make at least 3 times your subscription fee on your trading, your next month is free. Why do we do that? Well, we're options traders ourselves. I trade this bull put credit spread weekly positions, and I have been doing it since January. I've taken a couple weeks off when I thought the market was off. I didn't trade many in October. I think I traded 3 instead of the 9 or so I usually trade. Okay? Was it conducive to bull put credit spreads unless I did them on an inverse ETF? All that being said, we know that you can have a bad month. The market can give you a bad month. If you're doing all bullish strategy, you don't have an extra hedge like the VIX calls or something along those lines, you can lose money in a month with something that had worked 85 to 90% of the time prior to that. It just happens. It happens to everyone. So what we say is that if you don't make a profit, you don't make 3 times your subscription amount, $180 or so on your investments, then we'll give you your next month free. But we are going to get involved. Ernie and I will ask you, okay, hey, we're going to apply the guarantee, but what were you trading? What were your trigger points? What were your management steps? What did you look to roll the position? Did you roll the position or did you just take the loss? And we're going to try to guide you to other ways that might help you in the future from maybe avoiding losses or getting an earlier trigger in that point. Okay? So yes, it's still in effect. And then you had mentioned that you have an account of $35,000. Is that enough? Yes, I believe so. You might be doing smaller positions. You know, you've heard me talk about the different structures there that in my portfolio I usually trade about 45 to 55% of my positions is in the limited risk radioactive trades. That's a growth portion of my portfolio. Every position I open only carries about a 5 to 7% at risk, but that monetary risk only represents 2% of my portfolio. The credit spreads represent only about 15% of my total portfolio allocated to options. I do change direction when I think the market's gone. I might do bear calls when I see bull puts. I'm sorry, when I see the market go bearish instead of bull puts, or I might even do bull puts on an inverse ETF. But that whole credit spreads, any credit spreads, doesn't represent more than 15% of my portfolio, and each credit spreads I open really the monetary amount. So if I did a 5-point spread and got 50 cents, the monetary risk is $4.50. The number of contracts I select to make sure that total number, $450 for one, $900 for two, whatever, my contract size dictates that that should not be more than 4% of my total portfolio value. Because I can lose 100% on the credit spread, as we had seen before. Right? Al had asked before about, you know, getting a better risk-reward ratio or getting a better reward ratio because, you know, some of those spreads you might only make 27 cents on a 2-point spread. If you do one contract, that's $27, which you're only risking 200. That's the trade-off, right? That's the nature of spread trades. But if I do too much, if I said, hey, let me do 20 contracts, so at least I'm getting in about $400, what is my risk? It's $4,000. Okay, and I could lose that very quickly in a month like October on that full trade. It's not worth it. So anyway, 50% in sort of protected growth single-digit risk positions, 15% in maybe spreads, maybe 15% for me personally in another strategy like diagonals or long straddles. Leave some aside for cash, and about 5% of my portfolio I use with buying VIX calls, depending on where the VIX is and the price of those calls as well. Okay, so is $35,000 enough for that? Yep, I believe it is. That'll allow you to open about 3 to 4 married put positions, carry 3, maybe 4 bull put credit spreads over every 2-week period, have open maybe 3 to 4 straddles and 3 to 4 diagonals. And me personally, I don't like to trade more than about 15 to 17 positions at a time because I tend to lose my balance. I tend to lose my focus, okay? All right. Doug, good. There's the extra problem I was looking for. Okay, thank you. Got it. Okay, so Doug's got a covered call. I'm going to show something here real quick. Let me close out some of my windows, folks. It'll be easier for all of us. So James, I hope that answers your question again. You can read about, you can read about that performance guarantee. Remember, you can check it on the site map. It's just available there as well with the subscription info. That is still there. 35,000 I think is plenty. And you don't have to do what I do. I'm just saying, as looking at what I do now, that's how I break up my portfolio so that I have proper position sizing and coverage and I'm not taking too much risk. You can say, well, I'm planning on trading with $35,000 and I'm going to buy out of the money calls that are at least 20% out of the money for December, and I'm hoping the market's going to jump 30% by then. Now, I'd honestly say I don't think that's a good way to trade. If you're right, you're going to look like a genius. But I don't think that's a good way to trade. You have a higher probability of losing everything if you put all $35,000 into that strategy. That's why I diversified. That's why I have positions with protection. Not saying you can't be successful with covered calls, as we're going to talk about now with Doug. But I prefer the married puts and the collars because I have that protection in place. Again, I showed that pen position where I'm taking a 10% profit on a stock that's down 30%, and I've been long the stock for 1 month. And that's because I had the proper protection in place and caught the right tactical at the right time to do a different adjustment. But we got to talk about Doug now. Doug, what I'm going to do, we're in the portfolio here, and I'm going to create a new portfolio for us. I'm just going to call it SBUX. All right, we're talking about a SBUX covered call, and we're going to put in 10 grand as an investment and create this portfolio back on October 1st. Oh, let me copy that over. There you go. Okay, so let's go ahead and save that. All right, so why did I just create a portfolio? Because I'm going to show you first is a quick and easy way to answer your question. So Doug says he's got a covered call in SBUX. Cost basis is $58.30, and he sold the November 60 call for about 74 cents, 0.735. So I want to enter this into the portfolio. The date doesn't matter, but we're going to put in a date sometime in October. Let's just choose the 19th, for example. It doesn't matter what the time is. Okay, and I'm going to buy 100 shares of SBUX. The number of shares don't matter either. We're going to be focusing on the percentages here today. And I'm not going to put in a commission, Doug, okay? Cost base is $58.30, and then we sold the November 16th standard expiration, 14 days away, 60 call, 1 contract at I'm going to call it 74 cents. It was 0.35, right, Doug? Yeah, great. Okay, so why am I taking the time to put this in a portfolio? Because Doug's question was, is it a good idea now to roll my call up in price, maybe even out in time, or to just let it get called away in 14 days and look for others? Okay, whenever I'm tracking a position in the portfolio, I know that I added here the position analysis view. So if you liquidated right now, you're making about a 3.7% profit. Your max profit was 4.2% at expiration, which if the stock stays at the same price, you'll get that. You've got your cost basis down to 57.56. Get assigned at 60, 244, 4.2%. One of the features on the portfolio tool, whenever you're tracking any position, covered call, naked put, what I can do is use the more information button here, go to position actions, and then position analysis. Doug, this is going to give us a breakdown of your Starbucks call. I still see I have 0.5% of time value left in price. Why is that important? Some covered call traders and naked put traders may use the 1% rule as a buyback idea, meaning that if the time value drops below 1%, they might consider buying to close the call because they've almost milked everything out of it they expected to make. Okay? Some it's lower, 0.4, 0.3%, but that's why it's there. Giving you that gauge of where you are. Your delta's a 0.95. Yeah, we're deep in the money. That's expected. Okay. We just passed earnings, of course. Dividend date is not relevant. Oh, it is, isn't it? Next dividend date should be around 11/8. You might even get assigned early if it's in the money. But it's the 16th, so it's a hard gauge. It's hard to say you'd get assigned early that you're in the money on the ex-dividend date with the November 16th, but you might. So this might sort itself out if the dividend does come up at 11/8. Anyway, where are we now? Oh, that's really close. You've made 86.5% of what you expected to make, meaning, again, you've made $211 or 3.7 if you liquidate right now. Max return is 4.2, so the 3.7 is 86.5% of the 4.2 max you could make. 80% rule. Some investors will look to buy back their naked put or close their credit spread if they've made at least 80% of what they expected to make rather than leave it open. You're close. You've made 3.7% 14 days. This position has made 3.7% based on the opening date 14 days ago that I put in. I don't know how long you've been in the trade, but that's an idea. You could close now. Here are your rollout opportunities. These aren't all of them, but these are the ones that probably make the most sense. Stocks at 64.32, you currently have the 60. What is this table showing us? It's showing us we could buy to close our call for $4.65. We originally received 74 cents. I could roll out to the 23rd November, 1 week out, 64 call and get $1.18. Now my debit is $2.73. You have to ask yourself, are you comfortable rolling for the debit, or would you prefer to roll for a credit? That's going to point you in two directions. But what's important here, even if you roll for a debit of $2.73 is only going to put your cost basis up to about 59 something, maybe 60. If you're assigned at 64, it's a 4.9% return. This is what I was talking about in relation to Rhajiv's question a little moment ago. I can make 4.2% right now if I hold it to the 16th, or 3.7% if I liquidate right now. If I add an extra 7 days, this could go up to 4.9%. if I'm assigned at 64. Question, does 0.7% for an additional 7 days match your trading goal for a covered call strategy? Could you go up to the 65? Yes, you're rolling for a higher debit, but you increase it to 5.7%. But that's only if you get assigned at 65. The stock pulls back now, this expires, you're still in the stock with a $3.22 higher cost basis than you have now. That's what this tool does for you. It allows you to quickly compare where am I now? Where might I be in 14 days? And do any of these rolls for a debit make sense? Yes, they're increasing my return, but is it matching my trading plan? If I roll, to the 65, I only have a 42.2% chance of being assigned. Okay, Doug, so ask yourself the question. You can make 4.2% in 14 days. You could take 3.7% off the table right now by liquidating the entire position. Not sure what happens on Monday, but based on today's numbers. Is rolling it 1 week out, 2 weeks out, or maybe 3 weeks out to December worth it? Does the return match your goals for going that far out in time? Adding 35 days to go from 4.2 to 5.4. To me, that's an immediate no, by the way. That's me personally. 5 weeks out in time, 35 days from now, December expiration, close out my spread, close out my covered call that hasn't hit expiration yet, go out to 35 days out in time to move from a potential 4.2 to a 5.4 and add $2.42 a cost basis. I don't think that's worth it for me. That's not in my trading plan. Okay, that doesn't match my trading plan. If I go against my trading plan, I'm now trading against myself. If you're okay going just out to the next week, adding 7 days to November 23rd or adding 14 days to November 30th to move your return up to, say, 5.1 from 4.2. That's only 0.9% for another 14 days. Does that match your goals for the trading plan? I don't think so. With the numbers they are right now, and Doug, this could be based on volatility. This could be based on the high implied volatility of the calls and across the market there. Your buyback cost on this call, I'm sorry, it was up here, 465. You've got to sit, that's only 30, yeah, it's 30 cents and there's only 0.5% time premium. So you're pretty much at intrinsic here. I can't give direct advice, but I can just see based on the numbers that are showing here right now, rolling this option out doesn't make sense to me. I'm not getting what I want. I'm not getting what I need to match my trading goals for a covered call strategy or a collar strategy, so I'm either going to wait for a better opportunity. I don't know if it's going to happen, Doug. You know, it's always hard to gauge when the stock has weekly options, and I don't think they've canceled it. Oh, I'm sorry, I went to the wrong place. Stock research. I don't have an updated date for this, but I do show that the earnings date was on, the last earnings date was on 8/8 of 2018. If they're still paying a dividend, logic dictates that the next dividend should be on 11/8 or somewhere around that time frame. Check with, I apologize for not having the updated dividend, but check with your broker, see what their next ex-dividend date is, okay? Oh, it just reported and went up this week. Okay, so you already crossed the ex-dividend date and weren't assigned early. That's good. That's also good because you're on record of being held holding the stock. So guess what? You get the dividend too when that pays out. So fantastic. There you go. That worked out well for you. You weren't assigned early. So you could liquidate now and take 3.7%. You could wait another 14 days or so. Yeah, 14 days. That's right. It was 14 days. You could wait that additional 14 days to make the maximum 4.2. And the rollout opportunity shown on the portfolio tools where we do all the heavy lifting and the numbers for you, these don't make sense, and you're kind of in agreement with that. Let's maybe look for the next opportunity or see if we can find a better opportunity. But these just, you're not even able to roll for a credit if that's your goal at this time. That's not always my goal. I focus on the return. But if I go 14 days further out in time and I'm not increasing it by at least my goal for a 14-day trade of, let's say, 1.7, 1.8%, then the roll's not worth it. Doesn't match my trading plan. I'm trading against myself in that case. All right. Well, ladies and gentlemen, I don't see any other questions that have come in. Oh, shoot. I'm sorry, folks. I don't see any other questions that have come in. I think we covered everything that was there. I'm sort of stuck right now because something disappeared off of my screen. I do apologize for that, so just hold on a moment. And that's why. Okay, sorry. That was my fault. I do apologize. There we go. All right, folks. Well, I want to thank you all for joining me today, and I want to remind you, of course, some of you had questions about the blueprint, some of you had questions about the tools today. We saw how powerful the portfolio can be to help us analyze rolling positions and doing the heavy lifting for the new return for you. If you haven't done so already, you want to test out PowerOptions, just go to PowerOp.com. Just put in your name and email address. You'll have full access to all the tools for 14 days. Subscription levels following that start at $40 per month. But we do, of course, offer other levels of service, the delayed level of service, a real-time service as well. You can check all of that out at the subscription page or subscription info, the top link on your trial, or directly from PowerOpt.com. And check out some other education. Remember, you can check out the blog at any time, blog.poweropt.com. As mentioned, we have that archived webinars page. You can go to poweropt.com/webinars.asp to look at any of the tools, presentations we have, strategies, options, concepts, and more. Full archive of webinars. All of our Friday discussions are under the requested topics category on the webinars page. And you can check us out on YouTube at any time too, just under Power Options. If you think of any questions later on, just remember you can send me an email at any time to support@poweropt.com or support@radioactivetrading.com. You also call us during market hours at 302-992-7971. And reminder, of course, those of you that have started your trial or are currently subscribers, you can schedule the coaching session at any time, and I encourage you to do that. So that's not a sales call. Remember, this coaching session is just like we're doing today. It's a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site. We'll answer any questions that you have, help you to navigate through PowerOptions maybe a little bit faster based on the strategies you're using and the techniques you're using as well. So make sure you take advantage of those coaching sessions because they're available at any time for trial members and subscribers. Ladies and gentlemen, have a fantastic weekend. I look forward to seeing you next week. I look forward to seeing what the market has in store for us next week as well. And I'm not going to take sides, and I don't want to take sides or get into a discussion, but please remember, next week, go vote. Whatever side, whoever you vote for, please vote. It's very important. We always want to encourage that everyone get out and vote. So make sure you exercise your right and vote next week as well. And I'll be here for all your options needs anytime during the week. Take care, everyone. Good night.